Well, for our next keynote speaker, I would like to welcome to the stage Alan Merrill. He's the Senior Managing Director of Ankura Consulting Groups. And Alan's going to be talking about optimizing the value of FinTech partnerships. So please welcome Alan to the stage.
Good afternoon. Welcome back. I'm Alan Merrill from Ankura. Ankura is a specialized advisory consulting firm helping clients with partnerships and joint ventures, planning, structuring, launching, operating, optimizing, restructuring, and exiting those partnerships. We've supported over 600 through 600 projects around the world, some of the largest, but also some of the newest and most innovative partnerships across the financial services sector. So we're going to go through three parts of this talk before we get to questions and hopefully some discussion. The first is a few trends in the financial sector, partnership trends. Then some ideas or some steps based on some of our work related to optimizing FinTech partnerships. And finally, if we have time, we'll go quickly through a little bit more about Ankura. This shows the amazing increase in partnerships in the last couple of years. I think we're all aware of how much activity there is in the financial sector and globally across other industries as well. This includes both joint ventures and partnerships, and we have kind of an arbitrary cutoff as we look at this data. The cutoff is what we call significant joint ventures and partnerships, which screens out a lot of small, very small transactions and commercial deals. Across industries, it's interesting to compare legacy partnerships, that is those that have been around for a while, versus newer partnerships. And not surprisingly, financial services is the sector that has the highest proportion of newer partnerships relative to the stock or the base of overall partnerships, as shown here. We looked at, since in the last 5-6 years, we looked at 1,140 partnerships across the financial services sector to try to understand some of what's going on and some of the trends. You can see that in the years from 2016 to 2018, the number of partnerships was high, but in the last several years, it's really exploded. And that's true across all regions. The one interesting thing we found here is that over 72% of these 1,140 partnerships are non-equity partnerships. In other words, they're not equity joint ventures. They may have a minority investment component in some cases. That's a small portion. But the large majority of partnering activity that's going on in the sector, that has been going on recently, has involved non-equity partnerships. Also interesting that close to 70% of all of these partnerships have involved one or more FinTechs. FinTechs are driving a lot of the partnering activity across the financial services sector. And they're partnering, as you can see on the right side of this slide, with banks and credit unions, with payment companies, with other FinTechs, and with others. Not even others that are not even in the financial services sector necessarily. These are some of the examples I'm sure we're all familiar with in this room of some notable partnerships, examples of fintechs partnering with banks, with payment companies, with other fintechs, and even with others outside of the financial services sector. Now, this is where we started to dig in a little bit to understand what's behind these partnerships. What are they attempting to accomplish? And simplifying a bit, we boiled it down to three primary objectives of fintech partnerships. The first, by far, has to do with market access, market and revenue growth, whether that's distribution, customer penetration, channel innovation and development, new product innovation, and so on. It's about driving revenue growth. The second category, not surprising, relates to technology and process innovation, whether it's accelerating time to market or taking cost out of processes, doing things more efficiently. And then finally, there are partnerships that are focused on risk, financial management, compliance, gaining access to established regulatory capabilities of a partner, and so on. At the same time, and I'm sure, again, we've all seen some examples of this. There's a lot of buzz in the market about, are fintech partnerships really delivering value? Are they performing to expectations? And a lot of the research points to the answer that is no. Some of them for sure, but many are not. And that would be our conclusion as well, based on our experience. Working with our clients, we get into many situations where partnerships may be doing okay, but they're not really delivering the value that was expected from them. And we boil down the reasons for that to a couple of things, again, very simplified. Maybe three things in particular that are shown on the right side of the slide. The first is how the partnership is structured and designed in the first place. Are the goals and objectives defined and agreed on up front? Is there something about the operating model of the partnership that has not been thought through? Are the metrics not clearly defined? Or is there an imbalance in some of the commercial or financial incentives? Are things just not aligned from the outset? Second is governance and leadership. Is there a governance and operating model and framework in place that is providing the kind of leadership and attention to the partnership going forward? We often see a big splash around the announcement of a partnership, but then 6-9 months later, you notice that the attention of management is dwindling. It's just not getting the same priority and attention. And the ability to spot things early and do something about things that are not working the way they are supposed to be in a partnership becomes the problem. And finally, resources and capabilities. Another area where we think a much better job can be done in many cases. Either there isn't clear accountability for the partnership performance and results, or there's just not not enough dedicated resources to managing and overseeing the partnership. There's other research you may have seen at some point that talks about a very small portion of partnerships having dedicated teams. Usually they're overseen and they're operated by others who have other day jobs. And that can be an issue as well. And finally, there, of course, are technical and other kinds of capability constraints. Two companies might feel that it was easy to bring together two different product capabilities, but the technical obstacles have become larger than they thought. The API development, the integration of the back end, and so on. So three problems in particular, and we sometimes get asked, you know, what is the chance of a partnership actually delivering against expected results? And we have to answer it's not much more than 50%, and might even be lower than that. You can see on the left side some comments by the press, some folks that have dug into this topic as well. And finally, delivering partnership value and optimizing that value is important not just for the reasons that the partnership was set up, market growth or taking some process or technology or cost inefficiency out. But we found somewhat of a relationship between the activity of partnerships, those that are performing better, and the overall return on capital of the parents that are doing that partnership. Partnerships have, let's say, somewhat of a multiplier effect if they're performing well. This is a little bit of a, a data deep sort of slide, but it's the activity score is to what extent is a partnership being refreshed or even restructured when necessary, and then looking at some of the impact of that on the performance, the return on capital of the parent companies that entered into the partnership. So a few trends in the financial services sector, lots of partnerships, increasing rapidly, not always performing to expectation for a couple of pretty basic reasons. So we approach with our clients optimizing partnerships pretty simplistically. Let's look at, is this a new partnership, first of all, or is it an existing partnership? If it's a new partnership, we're going to suggest focusing a lot more on those upfront topics of structure, alignment, commercial incentives, and so on. If it's an existing partnership, we get into some of those other areas of shortfall, resourcing, attention of management, and so on. We have a framework, if you will. This is kind of the tip of the iceberg of that framework. But one of the things that we found our clients have become sort of particularly interested in is what we call a partnership diagnostic. That is, we've had, for existing partnerships, we've had a partnership around now for 18 months, for 12 months. We just don't understand. Is it the market conditions? Is it competition? Is it something we're not doing that we thought we would be able to do and pull off? And probably a third, 25% to 30% of our work is going into existing partnerships and doing a diagnostic. A diagnostic which leads to sort of an objective point of view on what's working and what's not, and what could you be doing about it. Diagnostics can be done in 2 to 3 weeks. They can be done in 2 to 3 months. They can take even longer. It depends on the client objective. And what they essentially boil down to are answering 3 questions. How's it performing overall relative to what we intended, the results that we've been looking for? What specifically is contributing to that progress or the lack of progress? And then, based on that, what specific changes or improvements do we need to identify, prioritize, and agree on and move forward with? I'm not going to spend much time on Ankara because I'd love to get some questions and maybe a little bit of commentary as well. I'll just rip through these quickly. We are ranked or rated by some as the leading advisor specifically focused on partnerships, JVs and partnerships. We have a whole lot of tools and databases and resources. We work across all industries, although financial services is a particular focus. And we do a lot of writing and publishing and research and books and so on and so forth. Anyway, enough about Ankara. Questions, please. Yes, Frank.
Good to see you.
Good to see you.
So this is going to be a gross oversimplification of JVs and FinTech, but I think there's a little bit of truth to it. I like to say that in the world of JVs that involve an incumbent, typically a larger company, and an innovator, technology first party, that the incumbent, who often has distribution, needs the innovation as much as the innovation needs the distribution.
Yeah.
And I'm not sure if that gross oversimplification tells the entirety of the story. I think your slide suggests there's more to it. But one, does it ring true to you? And two, doesn't that represent kind of competing interests that are often difficult to reconcile?
Well, that's a great comment. Frank Young from Global Payments. It rings true, Frank, but there are a lot of sort of nuances to it. In other words, they're definitely going into a partnership, a smaller, newer, potentially more innovative company is certainly looking for things from a bigger partner, a bank, a payments, established payments network, or whatever. At the same time, the larger entity, the more established entity, is also looking for some sort of innovation, some sort of technology, something that they have not been able to develop adequately and feel that they could access through the partner. Bringing them into competition, I think they perhaps were already competing before they started to partner. And in some cases, the competitive tension can be an issue in partnerships. But frankly, no pun intended, Frank, we haven't seen that be the problem that often, that two partners come together and are constrained because they feel they're competing against each other. They've made that decision more up front. And it's some of these other issues that they run into.
Somebody up front here.
Yes, please. Yep. Yes, please.
So, can you explain a bit more about, you called it neutral exit planning? Can you explain a little bit what the thoughts are about that?
Yeah, well, it's kind of the life cycle of a partnership. It is a transaction. It's a deal. If it's an equity deal, a large joint venture, 2 mining companies or something like that, or 2 banks, then it's there's a lot of legal, commercial sort of complexity to it. But the life cycle starts with upfront thinking about the planning. Does it make sense? Should we be doing a merger or an acquisition instead of a partnership? And a lot of entities decide that's the way to go. Then it's structuring, getting all of the terms and conditions and all the nuts and bolts in place. Then it's operating, it's optimizing, we call it, really trying to get the performance hitting on all cylinders. But then there are circumstances in which it makes sense for the partners to start thinking about either restructuring, maybe bringing in a third partner or many more partners into a consortium, or exiting. And exiting has to be done carefully. There's a reputational risk, particularly if this is a large visible type of partnership. There's a customer risk, potentially. There's intellectual capital risk and those sorts of things. So clients, we've found, do need some help sometimes working through the restructuring or the exiting as much as, not quite as much, it's not the majority of our work, but certainly along with some of the other help along the life cycle. I'm sorry, I can't quite see because of the light.
He's in the back.
Yes, go ahead. Whoever he's selecting.
Are these partnerships just a precursor to eventual merger or spin-off?
No, not typically. That's a decision that is often weighed up front. There can be a joint venture or a partnership where one decides to buy out the other. That's an acquisition, or take more of a controlling interest in a partnership. But it's not that common that you see one partner acquiring or merging with the other partner. It happens maybe 10% of the time or less. Because they've thought about it up front, and if they thought it made the most sense, they would have done it a little bit early on. But it does happen, for sure.
Let's get one last one here in the middle. Go ahead.
Yep.
You mentioned that about 3/4 of these are non-equity relationships. Did you dig down a little deeper? Are the ones that are equity-based any more or less likely to outperform the 50-50 success rate?
Yes, they are. We have dug into that to segment all of those and try to associate performance with different characteristics and so on. Typically, when it's an equity relationship, a joint venture, there's more visibility within the parent companies. There's a board that's established. There's a governance document that might be 120 pages long. Unfortunately, we've had to write some of those. But there's more at stake, in a sense. And therefore, the risk of there being not adequate resources, not adequate management attention is somewhat lower than a FinTech partnering with a payment company that might have thought, that goes into it without the same type of experience or potentially the same at stake from an equity point of view. Is that it? Or
Yeah, we're good.
Yeah, this has been on zero for a while here.
It's all good.
Okay.
Got to get some questions.
Yeah, all right. Thanks very much. Yeah.